And good morning, everybody. Happy Friday. Welcome into the Mining Stock Daily long form episode for this week, getting you through the last day of market and into the weekend. We've got two segments here for you in this week's long form. First, we welcome back Chris Vermeulen of the Technical Traders, where you're going to get some technical thoughts on a lot of different sectors within the market, specifically where things are heading in the major indices. We are going to talk precious metals, of course, as we continue to hover around those all-time highs in gold, and silver has had a meaningful move here in the last 2 weeks as well. And so we'll get into some of those details with the things people who listen to this podcast hold dear and true to them, like the miners, like precious metals and the sort. And then in our second segment, we welcome back in Kai Hoffman of SOAR Financial, and we're going to talk all things junior mining sector, where the capital is coming from, some big news items that have led the way in markets here the last couple weeks as well. So just a general great conversation on the junior resource sector as well. Special thank you to Minera Alamos, Arizona Sonoran Copper, and Visa Silver for their continued support of the podcast. And as always, if you wouldn't mind, hit that like and subscribe. And also, if you wouldn't mind, come visit us at our new project, Clear Commodity Network. clearcommodity.net is the website. There you'll find an active pricing chart for commodities anywhere from the metals to energy and agriculture, powered by dynamic content. We've recruited some of the best content producers in the resource and commodity space and have it all under one house, Clear Commodity Network. We would appreciate you visiting the site and signing up for those emails. All right, everybody, let's jump into my conversation with Chris Vermeulen. Have a wonderful weekend and be well. All right, Mr. Chris Vermeulen, welcome back to Mining Stock Daily. How you been?
I'm good. Thanks for having me. Yeah, thanks, Trevor.
Yeah, it's been an interesting couple months since the last time you were on the podcast here. There's a number of parts of the markets I'd love to dive in with you and kind of get your technical observations, what you're seeing in charts in a number of these sectors. Mm-hmm. But the number of the fundamentals have changed really since the last time you and I have talked. The Federal Reserve and central banks are in basically rate cutting mode throughout the cycle. There's some geopolitical kind of maneuvering here with BRICS that's happening over in Russia right now. That's having implications. Just a number of economic data points that have come down the pipeline here. And so maybe like big picture scenario, Chris, I mean, if you look back the last 6 months, I mean, how has your approach to markets and watching these charts, what has there anything structurally changed, since the last time you and I chatted?
Yeah, I say there's a lot of things. I think in the past month and a half, 2 months, I think we've seen the biggest change to me has been overall. I believe we're getting close to a major stock market top. I believe we're inching our way closer to a recession. Things are going to slow. There's all kinds of other economic data supporting all kinds of delinquencies and mortgages and credit cards, and business sales are slowing down. But the really big thing that's really stood out is the fact that the US dollar index has screamed higher. Mm-hmm. Gold has screamed higher. To me, usually when there's chaos in the world, the dollar does very well. And also gold can do very well. So the fact that both of those kind of fear kind of assets have been screaming higher, obviously there's all kinds of stuff going on with currencies, BRICS and Japan and all kinds of stuff. Sending it higher, but not too often we see the US dollar rally as strong as it has, and we see gold continue to move up. So to me, that's a big warning sign that they're like, I look at gold as kind of like, think of like planet Earth as a beehive. We have a hive mentality. And when gold starts to outperform everything else, like equities, that is the whole world getting nervous. They're worried about currencies. They're worried about bubbles in stocks. They're worried about real estate. They're trying to move to a different physical asset. So the other thing is utilities. We've seen utilities sector just skyrocket. And when it outperforms, especially as much as it has recently, we usually go into a big major market correction. So that is another big warning sign. We saw this just before COVID. We saw this back in 2008. And even industrial capital goods sector has done very well. And it's a very different mentality of why that one tops out. But, since you and I talked, a lot of these things have performed very well. And they just continue to strengthen the point that a lot of investors around the world are nervous. They're moving to safe defensive plays. And we just need to be aware that I think the music's going to stop here soon, sooner than later. But the trends are still up. I think you need to be long the dollar. I think you need long precious metals still in miners. And even the equities markets, they are still going higher. So as much as I'm bearish, you don't want to fight the trend. You still have to ride these trends out until proven guilty or proven wrong that they're, going the other way.
Yeah. All right. So kind of break this up here. This relationship that historically has been the gold rallies when yields rally, or yields drop and the bond market's a little bit bullish. When the dollar weakens, gold's supposed to go up. And so that traditional relationship amongst those three have completely gone out the window.
Yeah.
You have rising yields, you have a bearish bond market, you have a rising dollar. I mean, it just bounced off that 100 level on the Dixie,
Yeah.
and it's up above 104, I think above 104 was yesterday when I last looked, and gold's hovering above those all-time highs. And so, I wonder if we can break this down here into four different areas. I know that I'm going to ask you a lot of you, Chris, to try to break this down, but this disorganization, this atypical relationship between those three.
Mhm.
What is that? I think you kind of laid out the groundwork of what that means. There is some chaos in the world, and gold and the dollar are rallying as safe haven assets in preparation of what potentially could be. But when things decouple and they don't behave like they're supposed to, how do you start looking at this thing as far as an investment thesis and even your technical analysis? Do you have to take one and throw it out with the bathwater? I mean, do you take yields and you just like, it's going to act as its own, and I'm going to focus on gold in relationship to the dollar?
So I don't use yields for any of my trading or any of that stuff, but so nobody's going to want to hear this, but the reality is, like what I do, I'm a technical trader. The reason I became a technical trader, which means I follow price and I manage positions, is because no one can predict where things are going. Sure, we might be able to guess and be right more often than not, but when things decouple like this is when true experienced traders or investors stand out, because it doesn't matter if they decouple or not. What I do is I follow the money, I follow the trends. So if I'm following gold and it's going up, it doesn't matter what the is doing. It doesn't matter what bonds are doing. Each one I look independently as its own asset, follow the trend. Is there money flowing into it? Is there enough momentum to carry it forward? So when things decouple, all it is another one of those things, Trevor, where it's like things are out of whack and there's chaos and things are getting volatile because now things aren't moving the way they're supposed to or have in the past. So the biggest thing I think people need to realize is it's not about trying to figure out what all the data is saying in terms of, they've decoupled, or if the dollar's going up, gold should go down. It's more so people just need to realize there's extra volatility. We're obviously coming to some big pivot point in the world, in the economy, in the stock market, in commodity pricing, because everything's broken up and chopping around. And you just need to understand, you need to follow the price and manage those positions. And my whole philosophy is I'm not a big fan of diversification when it comes to the stock market or bond market. I just want to hold whatever asset class is the strongest. So if stocks are going up, I want to be long stocks. If bonds are strong, I want to be in bonds. If they're not either of those favorable, I might move into the US dollar index and just hold the dollar. So if you hold all of them, you're going to have some going up, some going down, and you end up with this really average return because you got winners and the losers are neutralizing, right? So yes, there's decoupling going on. How do you navigate it? Well, you pick the assets that are that the best, and then take advantage of the trend. Make sure you can identify it and play long the dollar, play long gold at this point in equities, until it actually changes trend. The fundamentals don't play into what I do. I mean, I do look at them. It's interesting to see things unfolding, but in terms of investors making money, the only way we make money is if price of our investments go in the direction we want. So I focus on that versus the fundamentals can like lead or lag by like a year in some cases. So that's a big delay. A lot of pain can be applied if you hold on to something just based on fundamentals.
Talk to me more about this relentless move in gold and precious metals. It seems like every week, at least one day a week, we've been hitting a new all-time high.
Yeah.
It's been very quiet. We're not seeing that little key, the Chiron on CNBC about gold making a new all-time high. It probably would have done that back in 2011. It's not doing it today. Your Uber driver and your barber are not talking about gold or gold miners
Yeah.
yet. It's been very, very quiet, but this move just keeps going higher and higher. When it continues to have this incredible high and way into overbought territory, how does you as an experienced trader kind of navigate these waters? Are you taking some profits where it's at and looking to where things might settle, or do you have an even higher end trajectory of where this price might end up?
Yeah, so there's a few different ways to look at that. So I own a lot of physical gold and silver, which I hold long term. I'm not looking to trying to turn a profit in it. It's more like an insurance plan. So I hold a lot of
Mm.
physical. On the shorter terms perspective, we're long GLD. You just mentioned, Trevor, how gold's in this kind of like nosebleed, extreme overbought condition. I believe it's overbought, but it's actually not that extreme. If you actually go from where the bottom of the start of a super cycle back in like 2003 to the 2011 gold top, and then you go back down to the like 2015 low in gold, that is, and you use Fibonacci extension, which is the most powerful tool for identifying two price targets in the future, how far it'll go. That chart pattern has been pointed to 2750. And I've been talking about
Mm.
this for years. When it broke out, when we started the new gold super cycle in 2019, I wrote about this. I talked about how 2750 is the next major upside target where something big is going to happen. That's the next super cycle or major cycle top. And so we hit that last week. We're hitting it this week, actually, 2750. Now gold is starting to show a little bit of volatility. Gold miners are now showing some volatility. Newmont, as you mentioned earlier on this call here, Newmont's getting hammered pretty big today. But we're just seeing a pullback. So gold is where it should be, but now it has run its course. And even if you go from a smaller time frame, like from 2019 to and the recent rally in 2020, use Fibonacci extension there, it also points to 2700. So we have two different cycles going way back that point to
Mm.
this price. So I believe, as you said, it's kind of overbought. It's at its target. Anything from here is really icing on the cake if you're long. I think people need to realize from here, we're probably going to go into choppy gold pricing, and then we're going to see some type of pullback. It could be fairly significant, could be to 2,400, could be back to 2,000. Because when the economy resets, generally we see almost all asset classes get pulled down with it, and gold could get pulled back. Now, there could be, some black swan that allows gold to continue to move up. There might be a gold backed currency, there might be a big currency crisis that's going on. But overall, gold is, I don't see much more upside. Anything here is just kind of like icing on the cake. So I think it's more so expect gold to trade sideways or down, potentially 10, 20 plus percent over the next several months. And
Mm.
then when it does and the economy has a bit of a reset there, I think that'll be like the next opportunity. It'll be like buying in 2009 for gold and miners, where we go into another multi-year rally. Gold goes up to 3,000, 5,000 and change, just rockets higher. Miners go ballistic. They'll actually take part of the next rally. So I don't see a lot of upside here in precious metals. I think people need to either lock in their gains or just mentally be prepared that gold is going to go through a volatile stage here, and it could take several months, could take a year to correct, bottom, and then start that next major rally to the upside.
All right. So the if you miss this run, what you're saying is that you feel like there's going to be a great buying opportunity once the dust settles, once this pullback is complete.
100%. If you miss this run, I think you'll actually have a better opportunity later. You might pay a bit higher pricing, but you're going to buy it and then it's going to go to the moon for like,
Hmm.
3 or 5 years. So you don't have this lag time. Like right now, people are going to have to suffer through like, oh, I gave back so much of my gold profits, right? But if you buy it after this next pullback, I don't think it's pulling back anytime soon. It'll just keep going higher for 3, 5 years. And who knows where the top will be in gold and silver. I think they could go very, very ballistic with everything that's unfolding.
Yeah. Well, and you wonder if this scenario does play out, if it is more of that louder generalist type of movement that just currently is not there right now, right? And as
Yeah.
we mentioned, like people like you and I who have been in this market for a long time, like we're obviously incredibly excited. Like we've been waiting for this moment, but nobody's really following us, right? Like
Yeah.
the generalists are not there. And so
Yeah.
maybe this next move, if it is to kind of play out the way you foresee it to, those journalists will come. But that is even, I mean, that would just add so much more thrust to that move higher, bringing in more, you know, of that regular capital that's maybe trying to find a home.
Yeah, they're the ones who are going to drive it to the moon. Like we're already positioned and we'll add to it when the time comes. The general and the masses, when they pile in, it starts to go mainstream and it's gold, 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 and every news stream and advisors are starting to push everybody into gold. That's when they're going to do all the heavy work for us. We'll already be in position. So, yeah, we live and breathe this. We're excited for it, but you really do have to be patient. I mean, I think the best investors and traders are those who wait for the trades to come, wait for them to unfold, not, just jump the gun, knowing it's coming. A lot of people jump in right now saying, oh, it's going to be so good. But it's kind of like you're buying at kind of a little bit of a bubble, a bit of a peak. It's better to kind of just
Mm-hmm.
let things mellow a little bit and then, get involved. So, because right now, if we have like 6 or 8 months of downward falling gold prices, it kind of pulls and cracks. There's a lot of places you could go put money and make money for those 6 months. So you could move into the dollar. You could be maybe inverse ETF on the stock indexes. You could potentially be long bonds and pull out another, 5 or 10% or 15% out of those other markets while gold pulls back. And then you have more money to put into gold and miners when we see them all coming together and seeing the masses starting to drive and participate. So,
You know, I, I tend to push back a little bit about the use of technical analysis with bonds. I mean, if you just look at TLT, I mean, I feel like those move in bonds are more based on the fundamentals behind monetary policy than it is momentum on a chart. And we just had two huge, well known traders come and basically say they're either not interested in owning bonds or short bonds, the last week, which is pretty fascinating. But maybe, you said none of your investment decisions are based on yields, but what about trading the charts in bonds? I mean, is it more fundamentally driven than chart momentum driven?
It not really. I mean, there's
Okay.
obviously fundamentals behind everything that I think move in the masses of the investors into things, but looking at the chart of bonds, I mean, we've been in a bear market since, early 2020. The chart looks pretty bullish for bonds. Now it's still in a bottoming phase. It's got that high volatility. It's all over the place. Um, I do like bonds. I think bonds can do very well. They're still trying to carve out a bottom. The momentum hasn't fully shifted to the upside. Um, and obviously, it really is going to have their big role here. I think why we've seen bonds pull back recently again is simply because I think people are worried inflation's coming back, which means the Fed might not cut rates very much, or they might not cut
Hmm.
rates at all and shock people in the next one. And so people are selling in fear that the Fed isn't going to do much of a rate cut. Obviously, if rates go down, we should see TLT rally. Um, so that might be delayed. I think TLT could actually carve out more of a bottom trade in this lower range sideways for several more months or several more quarters until the economy and things start to really fall apart. And as long as inflation doesn't go insane, then the Fed will most likely keep cutting rates and bonds should start a pretty nice rally. But they are definitely in a bottom, high volatility stage. And it is driven by fundamentals. Whatever the fundamentals are, or what the investors or what they think the fundamentals are going to be, the investors take action. And then what I do is they all read the news and create the movements in the assets. I follow the assets and how much money flow is going into it or out of it, and vice versa. There's about a whole bunch of different asset classes that I watch, and depending where money's flowing between risk on, risk off, so like could be the stock market or utilities as risk off or gold as risk off. Then I can identify on the TLT chart. I'm like, do we want to hold bonds? Is the trend changing to the upside? Is it being accumulated? So let everybody else deal with the fundamentals in the news and create the tsunamis of buying or selling. And I just look for those waves in the market, and then I play those waves on the
Yeah.
charts.
I think the bond market, so it's, thinking it's forward looking here. And we've obviously there's this
Yep.
election coming up in a couple weeks, and, either candidate, it seems like the bond market's kind of holding responsible here for their economic policies. On top of that, you've got concerns that the Federal Reserve began cutting rates maybe a little too aggressively too soon, and this could spark inflation as well. And, I don't want to get into a deep conversation on Federal Reserve policy because we tend to do that quite often. I don't think anything's changed since the last time I had a conversation on that topic here on the pod. But I'm just curious if there's anything that you're seeing in your charts, with your data points that you're seeing, with the trends that you're seeing, that maybe could signal more fear of another round of deep inflation heading our way. Any sort of things you're really watching on that front?
Yeah, I think inflation is lingering. I think it's holding up. I think what we kind of really need is like we just need to see sales and people tighten up their wallets and stop spending. We need a recession. And we
Mm-hmm.
need like people to unload their high priced inventory and give it away. There's got to be pain in the streets. And then businesses and everybody will start lowering their prices. Manufacturing will want the jobs. It'll lower the price on products and services because people will want to start to get, we need unemployment to go up. I think to get rid of inflation, I think we need a lot of pain and we need a lot of people to lose, unfortunately. But right now, people are still willing to pay the high pricing for stuff, and there's still a demand. So, I mean, overall, like the bond market is telling us, like TLT falling in value as sharply as it has in the past month is to me telling people are worried there's still inflation. It's still holding up. I think it's going to take time. I talked about this last year as well. Like the inflation, I think is here for a while, and it's going to be a slow fade out. Like it'll slowly fade down. I still think we're kind of at the top, kind of frothy, and it hasn't fully rolled over and started to really go down enough yet. So I think we need time. I think we need people to just stop spending money. We need to kind of go into a
Mm-hmm.
recession so that people stop gouging and they actually, factories and everything tries to go back down. It's tough because everything is so expensive now, and everybody's paid a premium for all the products they have in inventory and all that stuff. And people generally don't, it's just like gas prices here in Canada. They go up, to like a huge price, and then oil will get cut in half in price for like 6 months or a year or so, and gas prices never go down. Like it's
Right.
always an upward ratchet set. So we need a lot of pain for people to start actually saying, okay, I actually have to sell this lower if I want to. So and unfortunately, it requires pain. People need to lose and suffer for, I think, this to unwind and come down a little bit, try
But
to neutralize a little bit of the inflation.
I don't think there's a political will to allow that to happen. There's too many cooks in the kitchen, too many people stoking the fire because of the dependence on the stock market, the dependence on assets to continue to be elevated, to continue to not only, keep positive confidence in the economy within, the functionality of the countries that we live in. And, on the developed side, I might add, between US and Canada, I think we
Yeah.
can speak on, on that realm, but also just for votes. No politician wants a recession because it
No,
means they've lost.
100%. But eventually they always implement policies to kick the can down the road. Like the Fed, I think, is trying to front run this time, like the recession coming. I think they're finally like doing things ahead of time. But the reality is eventually there's going to be too much weight. There's going to be too much strain. You can't game a system. You can only game a system for so long, and then eventually it breaks. I mean, uh, I think eventually this will break, and that means there's going to be pain. I mean, no presidents wanted a recession, but they happen anyway. No matter what they try and do, eventually cycles happen, and I know they don't want it. Typically, this is a strong time for the stock market in terms of the whole political cycle, the election cycle, and all that. But eventually, a cycle will come into play and overpower whatever stimulus, whatever games they're playing to try to, support stuff. So that's the way I see it. You can only fudge things and stretch them so far before something breaks. And then
Hmm.
that's the reason why the great financial crisis was so painful. That's why the tech bubble was so painful. They kick the can down the road and everybody gets all these beliefs that, we don't want this, we're going to try and avoid it. Eventually it just breaks and everybody gets hurt. So I just believe it's going to happen again. I mean, it's happened countless times in history. So it's just a matter of time. And they always have a great way, the governments and all that stuff, of just kind of dragging things out. So we'll see. We'll see how it goes. I mean, that's why it's important to follow price action. It doesn't matter if the markets keep going up or if they roll over and crash. You just have to make sure you identify what trend and make sure you're going to benefit or at least avoid chaos if it happens.
It does seem like there's exhaustion across the board on so many different levels here, right? I mean, it's like not only in markets, but just societal. In this election year,
Yeah.
watching the economy, and I'm kind of surprised that that sense of exhaustion didn't kind of happen earlier. I remember if you and I were having this conversation at the same time last year, we could have a discussion about, a recession was going to happen the first quarter
Yeah.
of 2024. It's the same thing in 2023. There was a recession that was supposed to happen in 2023 after that really dreadful year of markets in 2022 and the
Yeah.
rate hiking cycle. It just hasn't happened, but it does. And I don't have any sort of technical information, no data points in front of me to support this. I just kind of my own spidey sense, but it does seem everybody is just exhausted and
Yeah.
just wants to hunker down, get through November, get through Christmas, and then start the new year. And I don't necessarily think that new year will ring in continued optimism. I think there's going to be continued concern,
Yeah.
considered new players at the table in different countries all around. And I think people are just generally just kind of, nobody likes it when the confidence of the future is, I guess less confident, right?
Yeah. Well, I was
I've been
just
reading a lot of Peter Atwater here lately, so like,
yeah. Well, I was just in Las Vegas with like 36 very, very successful entrepreneurs, business owners, investors for the last couple of days, and it is clear across like almost all fields. It's not the same as it was 2 years ago. Things have
yeah,
slowed. Everybody is seeing a total shift. Everybody's pivoting and shifting and adjusting, and the momentum has, to me, just like you, the spider senses, and from listening to other people in various industries, things have come to a grinding halt. I know a big business that was highly profitable. This will be like their first year of losses ever. They're on one of the fastest Forbes growing lists, and now they're going to take a loss. And they're cover all industries. They're auto, healthcare, finance, all this stuff. So the momentum is stalling, and it's just a matter of time before I think the music comes to an end. And we're seeing even the same in real estate. Real estate homes, there's a million for
mm,
sale. There's so much, like 6 months worth of supply right now. Nobody's willing to buy because things are just overpriced. And once support gets broken and homes start to fall, it's going to be a race for people to sell and undercut the next person. And so there's a lot. I believe we're just floating, just hovering on the verge, like a plane stalling. It's shuddering here, and
mm-hmm.
it's about to do the nosedive. But we just have to wait. I mean, it's amazing how long things can drag out. And I mean, you go back to the last real estate bubble, you could see it coming 2, 3 years in advance. You're like, it's coming, and the recession's coming. But it sometimes takes a hell of a lot longer than we ever anticipate. But the key is not to take action on what you think. It's to once it happens, take action to benefit or avoid it. And that's where we are right now. It's like continue to be long stocks and bonds, or sorry, stocks and gold. Because they're in a strong uptrend. But just know, I think everything's going to turn around. Real estate's going to nosedive. We're going to see probably the US dollar do really well. I bet you it'll benefit extremely well over the next year as things kind of fall apart. So
You kind of seem to be subscribing to Brent Johnson's milkshake theory: strong dollar, strong gold. Is that fair?
I I think gold. I think gold is going to get hit. I do think gold is going to
Okay.
fall. I mean, right now we're seeing them both do very well. Gold has just played out its cycle. To me, gold is like kind of done. I don't think there's a whole lot of upside. I'm not
Okay.
saying buy gold now. I'm just saying you should still be long it because it might go further. But I think the dollar is going to do well. And to me, that's going to be one of the better plays. Bonds, I think it will have some upside once it firms up a bit more. And depending if inflation lingers or inches higher, that'll play a big change. But I do think the dollar is going to be a big benefit of what's going to happen. And then
Okay.
after that, I
All
think it's
right.
going to get annihilated because we all know the debt. But I mean,
I'm sorry to laugh. That was just funny delivery, but it's not funny to you. I mean, it's really fundamentally not funny. I think just the delivery threw me off. But
right.
yeah, it's any sort of takes with this new BRICS system. I know I'm still waiting for like the final BRICS currency, but there's been a lot of talk.
I didn't know. I
Anything
don't
that
know much
plays?
about it. I don't really
Yeah.
follow it too much, so I can't give much
Okay.
insight on it.
Stick with what you know. All right.
Totally. Yeah.
Chris Vermeulen, thanks so much, my friend, for wonderful conversation. We're going to see how things play out, and you're right, at these very much overbought territory in gold, we'll see if a correction is due, but how deep and meaningful it is yet to be seen. Chris, before I let you go, let people know how they can find you and follow your work.
Sure. Yeah. They can find me on YouTube. Just type in The Technical Traders, or you can go to my website, thetechnicaltraders.com, and I share market analysis. I show my charts. I share the trades that I do with my portfolio. So you can just ride my coattails, copy what I do. I trade ETFs only. So I'm doing indexes, bonds, currency, cash. I keep it really, really simple, precious metals. Yeah. They can follow me there.
All right. All right. Thanks, Chris. Have a great rest of your week.
You too, Trevor. Take care. Bye bye.
All right, everybody, let's dive into the second segment of this week's long form episode, and it's all things junior mining, and maybe not necessarily junior mining. Let's talk about mine development companies as well, because we've had a number of big news items here in the last week regarding financing for mine constructions. We're going to dive into that. Happy to welcome in my German brother, Mr. Kai Hoffman, from SOAR Financial, and also the host of the Deutsche Goldmesse, the German gold show in Frankfurt twice a year. And that is coming up here in just a couple weeks' time later in November. Kai, good to have you on. How you been, my friend?
Oh, I'm doing great, Trevor. Things have picked up. Mood is better, less depressed. Mood has definitely picked up, much better mood. And it's good to be back on.
Remember when good news was punished? That wasn't that long ago.
That was 3 weeks ago, Trevor. That
It's
was
great.
3 weeks ago. Not kidding.
This time last year, we were all like sticking our heads in the sand and wondering when we were, what was gonna take to get us out of that rut. And it was kind of a slow grind up, but with that rising gold price, we did see bids coming into the royalty space, the major royalty companies. We saw bids coming into the major gold producers. Maybe we talk about that, because today, of all days, as we record on Thursday, the major gold producers are getting hammered on the back of Newmont financials. But then we started seeing a lot of M&A here in the last couple months. We've seen trickle down into mid-tiers and even into some, more of the more qualified explorers and developers. And we've seen a lot of capital come in. Maybe let's start with that, Kai, because with your project with Oren Inc., you do follow a lot of the financings up to a certain threshold of the micro caps. But, I don't have the data you do, but it certainly feels like there's a lot more capital coming into the higher qualified junior explorers. Am I right?
100%. You're spot on there, Trevor. And it's not just the junior, the higher qualified ones. Like, the tide is lifting all boats right now, and we're seeing financings being oversubscribed. I talked to a good friend here in Germany of mine, who participates quite frequently in placements. He's getting cut back. He's not even getting let into financings. So there's a lot of demand. I hear the silver financings in particular, like the ones Eric Sprott is involved, are absolutely bananas, for lack of a better technical term here. But a lot of money is being thrown at those companies. The financing window is wide open right now. It seems like all fear that we've had until, as I said, 3 weeks ago has completely disappeared. I think it has a lot to do also with the Fed, because we've been in a higher gold price environment for a while now, and not just for the last 3 weeks. Yes, we've broken now 2750, which is on the way to 3,000, like everybody wants to believe, and it is happening. the Fed rate cut and additional rate cuts that have been announced might have brought back some of that risk capital into the gold space that we haven't had because it was just shut and the money went elsewhere. And that has changed. And $2.9 billion raised to date, roughly within our coverage universe, which is not bad. Last year, we raised $4.6 billion. And when I did the last sort of roundup of numbers in May for a conference in New York, only $1.3 billion had been raised at that time. And that is just absolutely, what do you call it, underwhelming. Like, we're picking up the pace here tremendously, and we're making up for what we've lost in the first 6 months of the year.
Yeah, well, and I know maybe it's hard to kind of track this, but I'm kind of curious if where that capital is coming from. It doesn't necessarily seem like a lot of new participants are coming in. It mostly seems of people who are familiar with the sector that have kind of been on the sidelines, and rightfully so, for the last 2 or 3 years, who are finally saying, okay, now is the time. Let's deploy. Let's get this game plan, this strategy book back out, because we see the writing on the wall. And so those are the first movers, but we're not seeing, new funds coming in and participating in some of these financings.
I don't really see new funds popping up, but I did have conversations with new retail investors that are paying attention to this. Like through YouTube, like we were reaching a really wide audience, and one of them reached out. It's like, Kai, how can I invest in mining stocks? Completely new, and like I'm generalizing a little bit now, but I'm sure there's more than one person that wants to invest in mining stocks right now. They understand what is happening. The margins are increasing. While Newmont's numbers were underwhelming, one thing that really did improve was the margin. Yes, cost went up yet again for Newmont, $16.13, I believe, per ounce, which is extremely high, but they've had some extra costs, and majors always manage to finesse their finances when the margins should be increasing. They always find something to either write off or throw in there, which nobody expects. So that's why I think Newmont was sold off yesterday and today, and maybe dragging the sector down. But in general, there's interest in this space. And as you said, people have been on the sidelines, people that have been familiar with the sector. They might not have been as ingrained and entrenched as we are, but they've been following, but they haven't done anything. And one thing we've noticed at Oren Inc. is when the Fed started raising rates back in March 2022, that's when the wallets sort of seemingly went shut and were closed, and the money disappeared. And that was an interesting observation. Yes, the bigger companies and the further advanced companies still raised capital. We've raised $4.6 billion last year, which was a big number. But the juniors, the lower end of the market was suffering. And that is coming back. That is changing. And we've seen it in Beaver Creek, where we saw each other a few weeks ago. And it is trickling down. Like I see it on my in my trading software and the stocks I own. A lot of green on the screen the last few weeks. And finally turning positive with volume.
Yeah, I think I used the term a couple times in the last couple of years, like that bear market that we're just seem to be getting out of was the story of the haves and the have-nots. I mean, the haves were those companies, those management teams, the projects with good backing that could still go out and raise meaningful amount of money, even at depressed states, to continue to move the projects forward. But then there are those companies and projects and management teams that just had nothing. They were still kind of stuck in the sand, could not raise any money to do anything other than keep the lights on. And you were kind of hopeful, Kai. I know you and I had a conversation with this off record about, man, maybe we'll finally see some of these companies just go away and not exist. And to a point, we did see a little bit of like some merger news with companies, that maybe shared claims, borders of claims together, kind of wrapping the whole land package into one. We've seen a little bit of that, but not enough, I would argue. And we just saw companies that just plain simply kept the lights on and still didn't go away. And so I'm just kind of like, I think that would have been a good thing for this sector to not dilute the capital that does come in. But it just wasn't enough. I was kind of hoping that we'd see more zombies just die.
I call them cockroaches, because you can stomp on them. You can, even a nuclear strike won't get rid of them. They just don't disappear, right? Either they go into another space. Maybe they're a cannabis company for a while and they come back. Or they're just around, and I've tweeted about that before as well. Is like looking at some of the press releases, is like, oh, that company's still around, like a company that I've talked to like 10 years ago, and that disappeared, and all of a sudden the same name pops up again, the same people involved, the same suit probably they're wearing as well. It's just they don't die for some reason because the filing fees and the company, the stock exchange wants to string them along, and maybe they cut them a break. To stay listed takes you about $200,000 a year. If you don't take salaries and maybe you accrue them because in a better market you just pay them off and you pay yourself again handsomely. But what is it? The audit fees are $40,000. I'm not sure what the TSX charges these days, but it can't be more than $200,000. And oftentimes in Vancouver and Toronto, that's just a hat goes around. It's like, hey guys, at the Vancouver Club, throw some money in. We need to stay afloat. We got some ideas, but we don't want to dilute right now. We'll do that when we have a better market. Right,
Yeah,
and
right.
that hasn't changed. I don't think that will ever change. Sadly, it's just a function of the market and the function of maybe capitalism to a degree. As long as somebody's making money, be it the TSX, the auditors, those companies are not going to go away.
Right. You did mention Eric Sprott here. He's been active with financings and allocating a lot of his capital. I'll one up you though. You know who I think's been had a busier week? Randy Smallwood.
Oh yeah.
Oh my gosh, Wheaton was active today. 2 major mine construction announcements, one with Rio 2 earlier in the week, and then this morning, as we and I talked Thursday, Montage Gold having a big financing package for the Kone project in Cote d'Ivoire. Wheaton involved in both of those deals. We're going to try to get Randy onto the podcast here as quickly as possible. Don't you dare stake my thunder, Kai. But
He's all yours.
this is thanks. But I mean, they have been so active deploying capital, supporting projects, high caliber projects. I might add, not just any projects. They're not throwing darts at the board. But Wheaton has become, in just like that, a massive, massive leader in mine financing this quarter.
100%. It's great to see as well. It's a good name. Like they've always been like a decent royalty company and streaming company, and now a $625 million stream or royalty payment for Montage, $75 million US loan facility. That's a $700 million US dollar package, and it's really good to see. It's a good project. I'm really familiar with it. I've been to it. I've recommended it on stage at various conferences at 69, 70 cents, trading at 247 as we speak. The Lundins came in and are really pushing that project forward. It is going to get built. I'm certain of that. Now, definitely with financing in place, they're not just threatening anymore. They can execute. And that money is it's going to be well spent. And I think Wheaton's going to have a great time reaping in the benefits of that financing. So I think it's going to be win-win for all parties involved. The equity holders are for a change making money. It's not like we have to resurrect and refinance something that's completely gone to waste. I don't want to mention any names. That's not the point of this conversation. But this time everybody can win, and everybody is winning here if you participate, and that's something that I'm really, really happy to see. Gladly I'm involved, but if it wasn't me and all of my friends are involved, I'm just as happy because the sector needs this. This is a massive win for everybody.
Yeah, that in addition to the $120 million financing deal for Rio 2 in the Phoenix project that was announced and then quickly got upsized, not their portion, but some other portion of that position as well. But let's go back. Let's kind of go take a fine tooth comb a little bit. I want to ask you about this Wheaton deal with Montage, and you know the intricacies a little bit better. But listen, this is a huge stream. It was interesting. There was a big stream, some debt, no equity to this. But in the beginning of that Kone project production, they're giving away close to a quarter of the production to both Wheaton and Zijin. That is a hefty chunk of gold production to be given away to finance this thing. It's probably not without its critics, but I want you to be the critic. Is that, as a shareholder, are you happy? Are you okay with that?
I don't mind. It's a big project, and it can support it. Like the recent results from Gogombogo, they call it GB2 now, because nobody can pronounce it properly. It is making a big economic impact, and we haven't really seen the studies from from GB come out yet, and the full potential hasn't been tested. They bought the project from, or added that part of the project from Barrick not too long ago, about 2 years ago, 2.5 years ago, and they're still drilling it. But it is supporting a higher grade starter operation. So the first few years, it's not going to be a problem to supply Wheaton and Zijin with the gold needed. So I'm happy. You needed a way to finance this, even with the Lundins, the recent share price appreciation. It would have been impossible to finance through equity and debt alone. Glad that there's no equity involved, so dilution is staying where it is. They have diluted over recent months and maybe the last 12 months quite heavily already. So I'm glad that that's taken care of. You've got a good partner, and I hope the financing partners don't push Montage to do something too drastic in terms of development timeline. We've seen that happen at other projects where the finance partners might have been too aggressive. I hope Wheaton and Sijin are have some cooler heads and let the company develop the project in a way that it is intended, and to do the proper pre-development and other things so that it works out and we don't run any ramp-up issues. I'm not too concerned about that part, but having Wheaton come in, I think it sort of shows that. And there are other royalty and streaming companies out there that might not have the cool heads and are in for faster money.
Mm-hmm. Okay. What else is kind of like been of general interest with you in this sector here, Kai? I mean, any sort of specific stories that you're interested in, or maybe even just general themes here? We've talked about the capital. We've talked about, financing and bringing projects online here. If the story was about the haves and the have-nots, where does that general theme lie? Who are the haves and who are the have-nots still?
I think it's still the later stage projects that have a resource or are about to announce a resource that PEA stage to a degree. And that's the interest we're seeing when we take companies around Europe as well. The investors are keen. They're willing to invest. But it has to have something. It's still difficult for grassroots exploration. Don't get me wrong. Like, you still won't raise $10 million for something that's never been drilled before. That still doesn't happen. But there's more money readily available. In terms of trends, I think it's all trending towards gold. $27.50 for the gold price. Yes, copper at $4.30. It's not a bad deal. But I think the recession fears are still looming a little bit. We have the U.S. election coming up, so the macro side is sort of muddying the waters for copper for now. We'll get some more clarity here. We've had the China stimulus pushing copper and base metals higher, but the copper companies are not really coming out. It is quieter on that front. It's all focused on gold in terms of the equity stories right now, and deservedly so. Silver, of course. Sorry, I almost forgot. Silver is attracting a lot of attention. I mentioned it earlier. The silver equities are being bombarded with cash right now. Companies or investors want to jump on it. Everybody thinks silver is going to explode higher and maybe reach new all-time highs. It definitely has that momentum since we've broken technical resistance, and that is what we're seeing. And I'm excited that there's money available. I spoke with one company that raised money, and they said, Kai, we could have raised $50 million. Maybe you should spin out a project and just raise $30 million because we could. And I just laughed it off, and I hope they don't do it. But that's sort of the sentiment, is like, there's so much money around right now. It's crazy.
So if we talk about us degenerates in this sector as being, internal, let's talk internal, because there's no outsiders. There's very few generalist outsiders coming into the sector quite yet. Although I'm sure that, like, as you mentioned, anecdotally, they are having conversations. But I would say internally, Kai, sentiment seems to be a little bit frothy here. I mean, it's been pretty loud and exciting here amongst us.
Yes, but I'm not sure that's the end of it. If I look at the share prices, yes, we've seen a lot of appreciation, like especially in some of the juniors, and the stocks are moving, but they're nowhere near levels from August 2020 or 2021. So I think there's still room to go. Yes, we're excited. A lot of some people I talk with, they still are looking for those liquidity events, and I don't really understand why. Maybe they're sitting on some dogs that they need to get out of their portfolio, which is fine. I still own a few as well that I wasn't willing to sell during the down market, which I might have to reevaluate now that the share prices have moved. So that's sort of what I'm looking at. Like, there is still a lot of room to grow, and we often talk about, maybe I'll mention one company because we're both really familiar with it, is Minera Alamos, for example, right? Mm-hmm. Macro headwinds from Mexico, maybe open pit ban, no open pit ban, nobody knows really. It doesn't seem like it's headed that way, but that stock was trading at 72 cents, and we're barely broke 40 cents the other day. Right? Just as an example, there's tons of other names, but we're both intricately familiar with that one, and you had Doug on your program a number of times. So, unless we get to 70 cents again, I'm not too worried that it's frothy. There will be pullbacks. We've seen it yesterday in the market where silver corrects 4%, but that's healthy for a bull market, that we see those pullbacks and shake out maybe some of the looser hands. But dips are being bought. Right, and one of the first guys on the program, and on my programs, said like 2 months ago, buy the dips in gold and silver. It seems like it's finally our turn where we can say buy the dips, diamond hands, rocket, and all that stuff, right? And I'm not trying to exaggerate and turn this into a meme conversation, but it feels good that it's finally our turn. Like, I've turned extremely bullish over the last 3 weeks. You know me. Like, back in May, I stood at the Deutsche Goldmesse on my stage and said, this is the bottom. Like, I didn't probably hit the day, but I was probably awfully close within like 4 weeks, right?
Yeah, you're pretty close.
I was pretty close on that. And it's just a gut feeling, and there is momentum right now. The market wants to move. Let us see $50 in silver. We haven't seen anything yet in terms of share price because, as you said, like, we're still chatting amongst ourselves here.
Yeah, and maybe this is to kind of negate what I just said about the frothiness internally, but to go against an debate against me, I remember fall of 2022, I was inundated with new IPOs, new ideas, new companies coming on. My desk was filled with them. I've got nothing right now. I've got nothing. In fact, one of the few IPO, actually private deals that I've done have been in the last year before the cycle started its uplift, which is, a good sign. That I guess that's when you want to do it. I think I did that right. But time we'll see. But there's no inundation of new gold companies coming online. No new deals.
No, I think I've seen one yesterday, but I think it was a copper company even that my broker sent me. That was a new name for me. That's a private company that's raising $10 million right now. I have to look it up, but you're absolutely right. There's no seed money, no seed founder, no founder shares or founding rounds going around really. So it is quiet.
Yeah. Okay. Kai, let's talk about Deutsche Goldmesse next month. It's happening once again in Frankfurt. Give us a sense of what this episode of DGM has in store for everybody.
Oh, absolutely. No, great pleasure. Appreciate that, Trevor. And November 21st, 22nd, back in Frankfurt, we're at the good old Westin Grand, phenomenal location for us. We'll have 25 companies joining us, 6 keynote speakers, First Majestic, Dolly Varden, just to name a few, Go Gold. In terms of keynotes, I put a controversial roster together on purpose. Like, one of them is Henrik Seeberg. And if you're familiar with Henrik Seeberg's work, he actually calls for a gold price crash before a big rally. His gold price target was $2,700 post-crash. We haven't seen the crash yet. So I'm curious what his new theory is now that we've reached 2,700 and whether he still believes in a crash. I like having those controversial discussions. And he comes from an Elliott Wave business cycle analysis viewpoint, which is a bit different than all the others, more of the doom and gloom, the dollar's imploding, let's own gold. So it's a bit of a different conversation. But also we have Clem Chambers, Keith Neumeyer is going to speak, Matthew Piepenberg from Von Greyer's Gold. Great, like I always call him historian. He's not a historian, but he likes giving historical context to his predictions and forecasts. Christopher Schmidt from Incomet, more to educate on how to invest in mining stocks. Like, now is the time to look at them. You haven't missed the boat or anything in terms of share price appreciation at all. And Garrett Goggin as well, Gold Portfolio, is coming out from the U.S. To share his insights into the market. So it's going to be a fun 2 days. And by the way, like, maybe as an anecdote as well, when I said in May this is the bottom, it was because we had such a hard time organizing the conference and getting companies out to participate. It's changed in the last 3-4 weeks, and we've added a lot more companies just the last 3 weeks than we've added in the 3 months prior, right? And that has changed. So another interesting gauge of sentiment.
Yeah, very good. It's a great event. I'm sadly will miss it this go around. My first one in years.
Taking it very personal, by the way.
I know, I'm really sorry, man. But let me make it up for you. So on top of Deutsche Goldmesse, we are also syndicating the Soar Financially YouTube stuff on the new Clear Commodity Network. Happy to do so. You can go visit Kai's YouTube channel and all that content at Clear Commodity Network, and then the rest of the content we're syndicating at ClearCom. Do go. We'll try to get a link up to Deutsche Goldmesse for anybody interested to inquire about attending that as well, if you just happen to be in Frankfurt or in Germany at the time. Kai Hoffman, you're one of the best. Thanks so much for your time, buddy. Good to see you.
Trevor, thanks for the invite.
All right, everybody. That's a wrap this week on Mining Stock Daily. Again, check this episode out along with the other episodes through our syndicated list of content providers at clearcommodity.net. We'll be back Monday morning with the morning briefing. Have a wonderful weekend and be well.